we didn't talk about it, but where SBA is really valuable is that they're willing to do riskier loans than what a bank will do.
Real estate is really an opportunity. Most people are just not familiar. Let's change that. Access granted. Hey guys, my name is Gus, and I'm sitting here with
Brad Maxon.
And, we are with the Commercial Department podcast, and we have a special guest today who's going to be chatting with us about some financing things. There's been some changes in the financing world, specifically as it relates to SBA, and SBA is a topic we've been wanting to talk about for quite some time. So I was very happy to hear that our partner, Dane, is actually going to be able to talk with us a little bit about what an SBA loan is and, just some of the new updates that's happened with SBA. So Dane Foxworthy from Empire Financial, if you'd like to say a few words, introduce yourself or whatever, we appreciate you coming out.
Hi. Thanks, Gus, so much, and Brad, for having me on. I'm excited to share my knowledge on SBAs and anything else that you guys have questions on. So I'm a mortgage broker, work at the brokerage Empire Financial. We do commercial, SBA, as well as residential. So a large mix of products that we offer. As you mentioned, SBA does have some rules upcoming that are changing that, just came to light last week. So
yeah. And we'll get into that. I don't want to get into that right now. Before we even get into like what changes have happened, I think it's important for people to understand exactly what SBA is, and then, kind of what options exist with SBA. So first and foremost, SBA, what does it stand for, and like who is it designed for?
Okay, yeah. So SBA is a small business administration loan. So I like to tell people it's the FHA of commercial. So what that means is the government is insuring this loan, 85% of it. And because of that, they have a lot more guidelines and items you have to follow in order to qualify for one. Now, because it's insured, just like FHA, they can essentially do a more risky loan than what your conventional commercial loan at a bank would do.
And just for clarity, SBA loan it's not like an organization you get an SBA loan directly from. It's a bank that leverages the Small Business Administration that insures a loan that the bank ultimately does. Some banker.
Exactly. Okay. So all these loans are going through some type of bank or a non-bank lender for these SBAs, and they all have their own guidelines and rules, and they're taking on risk as well. So they're following the SBA guidelines to approve the loan. If they fall off of the guidelines, essentially it's not insured by the SBA, but that's the risk they take.
And then each of those lenders may also have like their own guidelines layered on top of SBA.
Oh, absolutely. Yeah. So for instance, a lot of lenders, they won't touch hospitality. So they don't like hotels. They don't like, everybody has their credit box they prefer, just their expertise is in.
Yeah.
So that's why there's a large marketplace for these lenders out there.
Gotcha. Now there are a couple different SBA loan types. Can you talk about that?
Yeah. So the two main ones that I've worked with are the 7A and the 504. And there's also like micro loans, which is not really what I've messed with, I guess you would say. But the 504 and the 7A are kind of your main big ones. Now, what makes the 7A is more flexible than the 504. And it's usually the preferred one that most people go after, the 7A. So the 7A is more, think of it more like a business loan. So you could acquire a business with it. You could acquire property with it. You could acquire the inventory on the property, equipment, vehicles, things like that. that go with buying a business. So that's the 7A, right? Now the 504 is more real estate driven. It, like, if there's a large tract of land that you're going to, you know, put a warehouse on, you want to build out the warehouse, and it's more the real capital on that land, not so much like the forklifts and the machinery that go into that building, but the building and the land itself. Now the 7A, where there's flexibility, typically it's a more expensive loan and the interest rates are a little higher. The 7A goes only through the lender. So they approve it, they close it, and you're only dealing with them. The 504 has to be approved with the lender and essentially with the SBA as well. And so you have two lenders. And the second lien, the SBA lien, it's a lower interest rate. So your blended rate is lower because of that.
I see.
Now the 504s, typically they have a 10-year prepayment penalty. So it's kind of a buy and hold kind of loan. The 7As have a 3-year prepayment penalty.
Gotcha.
Typically, yeah.
Is it possible if I wanted to have a business loan and part of, let's say, the expansion of my business, I wanted to also purchase another property or something, could I use it for that? Or is it really just I need to use the 504 for that?
So the 7A, you could purchase property with it. And so most people prefer to go, like I said, most people prefer to go the 7A route because it's so much easier to do. Like the 504 is twice as much work than the 7A.
Gotcha.
Yeah. So
it's more challenging.
Oh yeah. And you'll want, like a 504, you're going to want kind of a loan that's very straightforward and a clean credit box, right? Whereas 7A is more like you're doing a little bit wild stuff, let's say.
Gotcha. So, when you're looking at, like, how do you determine with someone when you're looking at these options for a client, how do you help guide them as to which of these products is going to be more ideal? If, let's say, they had, part of their expansion plans was to buy, let's say, buy property, and maybe the property might be slightly more challenging than a traditional purchase, for example.
Yeah. So kind of the first thing is the loan amount. So a 504 can go up to 25 million. A 7A can only go to 5 million.
I see.
So the first thing is if they're trying to buy a $10 million warehouse, it's automatically on the 504, right? Mm-hmm. Now, potentially you could stack a 7A with a 504 on the same acquisition.
Oh, that's interesting.
So if there's equipment to take down on the purchase and the appraisal doesn't work for that equipment, essentially you could do the 7A to acquire the equipment or inventory, and then a 504 to acquire the land, the real estate.
Mm-hmm.
Right. So not a lot of lenders don't do both. Some like to specialize in one or the other. And the 7A is more popular for sure than the 504. Now now let's say it's like a $4 million property, then guidance would be, are they very rate sensitive, right? Mm. How profitable is this business? Do they want to shift out of the 7A, out of the SBA in the next few years, or are they okay to finance and just sit on it forever?
Gotcha.
And those kind of decisions that people have, like, guides them towards the 7A or the 504.
Understanding their exit strategy already. Yeah.
Exactly. Yeah. So like I said, with the 10-year prepayment, it's not ideal to get out of at all, right? Mm-hmm. And so, like, some banks, they have conventional financing and the 7A, and so you can quickly transition out of the 7A into their conventional financing. That's what some of them prefer that, right?
Okay. Now, is there any limitations to how often or how much you can borrow on any of these loans? So are there any caps if I want to get a second property or borrow a second or third time? Like, are there any limitations to that?
So with the 7A, the main limit is just that 5 million. So it's kind of a global $5 million limit. So let's say you have a 3 million already and you're going to try to buy another 3 million, then likely you're going over your limit. So you can't pull that off. That would be the main limit. But otherwise, the 7A, essentially it all bunches together and you can continually add on to it. Just the processing time to do it is the main thing.
Gotcha.
Yeah.
Now I've heard of like, if you wanted to buy a second property, you could essentially get, more money than the property's worth. Can you talk about that? I know very little about that, but I've heard.
Okay. So let's say that you have a property that you're buying and the appraisal for that property comes in high. So you're walking into that first property with equity, right? You can leverage that equity essentially as your down payment on the second property.
Oh.
So let's say you have excess $300,000 on a property based on its valuation, right? So if that property is already under the 7A SBA, they're like, man, you've got all this slack equity. So when you go to buy the next one, they're like, okay, we'll make up like your down payment, whether it's 10% or 15% that the bank is requiring, they can pull that down payment from the original property's equity.
Oh, so you get like a credit.
Oh,
yeah.
That's
interesting.
Yeah.
Okay. Okay. I was trying to figure out like why would they, that seems really risky, but I see what they're doing.
Yeah. So let's say they're, the one I ran into, there was an RV park, right? And they were trying to refinance a loan that was 1.8 million. Well, the appraisal came in at 3.6.
Okay.
Right. And SBA doesn't technically have a cash out refinance. So that you can get cash for capital, right? So like qualified operating expenses, you can borrow that. So that essentially that's your cash out. So they're going to look at what your operating expenses are and then designate how much you can actually borrow. Up to, let's call it around 400,000, you could probably get out if you had qualified expenses. So now they had all this excess equity, right? Beyond that. So they went from 1.8 to 2.2, and now they're still sitting on an extra 1.4 million of equity. So essentially with a 7A, there was room for them to buy, another $2.8 million of SBA loan. And because they had excess equity on that original property, they could go in and buy 100% financing for another 2.4 million or 2.8 million in that sense.
Interesting. I did not realize that they had that kind of flexibility.
Yeah.
So if you're looking to buy like a second location, for example, you could effectively get that location and all you have is closing costs.
Right. And the seller could bring closing costs to the table for you.
And that's true. That's true.
Yeah. So like if you're looking to like the flexibility there, I think is really one of the, the main proponents of the loan, I think, in that, let's say that you want to quickly strike, a property and take it down that maybe it's struggling a little bit financially. If your core property can carry the loan of both, right? And there's something you're like, hey, we want to add facilities to that property. We want to do construction. We want to change all this stuff. And you can't prove that it's going to cash flow by itself, but as a business owner, it will. Or it's strategic for you. That original property can carry that note for you and from equity or cash flow.
Interesting. And that would be for like if I want to pull either a 504 or 7A, or that would be for one or the other.
So the 7A is the more flexible one for doing it that way. Yeah.
I see.
But you could shift the 7A into a 504 once, if it makes sense. Like let's say you get it and you need to unlock that 7A money, that 5 million. You would shift it into the 504.
And that's after the acquisition?
You could do that, but there would be that prepayment penalty essentially. So you would want, once you get to 24 months, the prepayment penalty is just 1% on 7A.
Gotcha.
But so a lot of people shift at that point.
On that anyways.
What's that?
You only got to wait 36 months on that anyways.
Right. So it's a 3-2-1. So the first year is a 3-year prepayment. So you got to think, if that $5 million flexible like line of credit you got essentially is worth taking a 3% hit, then you could immediately shift it out.
Otherwise, you're holding it for 3 years and then you can shift it out at 3 years.
Right. For
With
no
no
penalty.
penalty.
Correct.
Okay. That's interesting. I didn't realize that SBA allowed for that type of mobility. This is really interesting because we are very focused on entrepreneurs, and there are a lot of entrepreneurs out there that already own property, and maybe they use an SBA to get that initial property. But I would be surprised if they knew about this kind of flexibility that exists with an SBA loan, because I feel like I'm relatively knowledgeable about some of this stuff, and I had no clue that was even a possibility. So that's really cool to know, the fact that SBA allows you to leverage the existing equity you have in your current property against a future purchase.
Yeah, and the cash flow as well. So so if with SBA, you're going to create a pro forma for, let's say it's a new venture, right? And you can't prove adequately that it's going to cash flow. So essentially, you're going to create this pro forma, and let's say on a legitimate pro forma, the ramp up is slow. It probably won't start paying for itself until year 4, year 5. So you can leverage that, not only the equity, but your cash flow from the core business for the expansion as well.
Gotcha. That's really cool.
Yeah.
Okay.
Yeah.
So I was we try our best to keep up with just sort of changes that are happening in the commercial market. And one of the things that happened very recently was an announcement by the administration about some changes happening to SBA. And it actually it happened to be that it's impacting a project that that actually we're working on together, and we're having to figure out how to do this another way. But can you talk a little bit about that announcement basically was talking about only 100% American citizen owned businesses are going to qualify now for SBA. If you're not 100% American owned, then you wouldn't qualify. Can you just kind of talk about?
Absolutely.
So how does that impact, I guess, in your mind, just that whole environment? Like, what is it? How does it impact that environment? That's kind of what I want to get an idea from you as a mortgage lender.
Yeah. So traditionally, the SBA has been available for 51% ownership of the company is a permanent resident. So before that, you could have non-permanent residents or owning up to 49%, essentially, right? So
you didn't even have to be an American citizen to qualify. To have you didn't have to have
before.
Right?
So last year they changed the rule that it had to go 100% permanent resident. Right. So just to compare it on a residential side, a conventional loan, just your standard conventional loan, you don't have to be a permanent resident to get one of those, right? You can be you just have to have legal status essentially, and you can get a regular loan on a house. Now, FHA also changed kind of similar time as SBA. They said, hey, we shouldn't be giving these government insured loans to non-permanent residents, right? And then SBA said, same thing with SBA. We want our insured loans to be permanent residents as well. So essentially somebody with a green card, right?
Yeah.
So what happened just last week, you know, I guess it was early February, is the SBA came out and they said, okay, from now on, starting March 1st, 100% of the company has to be owned by a U.S. citizen, right? And so now the permanent residents don't qualify for these small business loans. And so kind of, you know, without getting political, what we're looking at is kind of a, you know, a large growth of, or a large engine of growth are these small business loans, you know, for the United States. So, you know, we didn't talk about it, but where SBA is really valuable is that they're willing to do riskier loans than what a bank will do.
Right.
And so kind of where people fit the credit box for SBA is they don't have, you know, the huge business experience. Like they might have experience with the industry, but maybe they don't have 5 years running a business directly that a bank wants to see. They don't have the huge assets that the bank wants to see. Where SBA is willing to take that risk on a business owner, even on a new venture, like new construction, to build a facility for somebody who's never run a business before. And SBA would do that, where a bank, they'll laugh you out the door, right? So what we're seeing now is only U.S. citizens qualify for these higher risk, you know, high economic activity loans. And so you're going to see less origination across the board because of it.
Yeah.
So how should these investors with foreign partners or investors who have foreign themselves kind of move forward with what's being proposed at this point?
Yeah. So essentially they can't be partners at all. Like before, it could be like, hey, you know, I have the capital, I've got the experience, I just can't carry the loan because I'm a foreigner, right? And so they could partner up with somebody who's here legally. And then it shifted to like, I need to be here legally to get these. And now it's like, I've got to be a citizen. So moving forward, I think, unfortunately, I think you're going to see a shift into more private money. Likely, you know, private money is going to want 25% down payment to 50% down payment
Right.
on these riskier loans, where SBA can do it with 10% or even 5% only, or in some instances, 0%, right?
Yeah. That's interesting. I'm interested to see what that dynamic looks like. I mean, I think in concept, like I can see why the administration is making the shift, right? It seems quite abrupt, is my concern. But I mean, sometimes that works, sometimes it doesn't. I guess we won't know until only time will tell whether, like, how significantly disruptive something like this may be in the world of business. I do know that, you know, a lot of business owners are either foreign or have a foreign partner, or just a non-US citizen partner. So obviously that removes them. The question I wonder is, you know, whether or not, and I guess this is sort of a cultural thing that has to happen in the United States, is that, you know, getting more people to think about starting a business as opposed to just trying to find work, which I think we're going to have to do. And again, I'm not trying to get political, but just with our economic environment and with the challenges that we have with sort of job growth, and it's difficult for Americans to get jobs, and most of the problem is that we have a hard time affording ourselves. We're expensive. Americans are expensive because we have we have, all of our stuff is expensive, like all of our things are expensive. Life living here is expensive. So, I think that entrepreneurship is probably a really good vehicle to help mitigate some of those challenges. The question is there a strong enough cultural shift that'll happen that will get more Americans to seriously consider getting into, building a business? So I hope that, there in addition to this shift, there's also going to be other things that'll help get people sort of off the bench about whether or not they want to start a business or not. Because it is still a great opportunity. I mean, I guess I don't know if it's fortunate or unfortunate. It seems like it's a little bit unfortunate in the short term. But fortunately, American citizens still have the ability to be able to leverage this amazing tool to be able to build a business, well, like you said, with little to no experience and little money to even get into it in the first place. So literally, if I have a good enough idea that I can put on paper, for all intents and purposes, I can go to SBA and say, hey, will you fund this? And SBA, there's a good chance that they will.
Right. Absolutely.
So it's still a great opportunity. It's just it's only available for it's available for less people. So
right.
Hopefully we can build a bigger like entrepreneurship culture that will allow individual American citizens to be more aggressive with their entrepreneurial ideas and to build something. At least that's my hope. You know what I mean?
Well, I think too, like with it, like what we're seeing with AI, I think what we're seeing is that people at their fingertips have expertise that they didn't have access to before.
Absolutely.
And the way I think of it is like, the playing field is very uneven for like experts versus novices. And that with AI, that has tightened much more.
I would agree with that. Now, I will say with AI, in my opinion, it's like having a 5-year-old who knows everything, right? And the advantage to that is, oh yeah, the 5-year-old knows everything. That's the advantage. The disadvantage is that they're still 5, and they don't really know exactly what is exactly right and what is not right. So it still needs supervision. Like you still need a human supervisor to supervise the AI, because at least what I've seen is there's so many people who are just looking at AI as like, oh, that's the answer, and it's not, right? Where the answer is just wrong. The AI gets it wrong. So I do think that there is definitely still value in expertise, and I agree with you that having that expertise at your fingertips with AI is super advantageous. But we just have to be careful, because that expertise comes with an expertise in the wrong information. Right. Now, I would say still, all that being said, 90% of the stuff that AI says is on point, at least as it relates to stuff that is common practice. So very highly specialized things, I think, are probably still challenging for it. So, for example, my wife is in property management accounting, and a lot of that stuff is very behind closed doors for obvious reasons. They don't want to disclose stuff and how they operate and how they do things and how they, all that good stuff. So a lot, like she's made attempts to use it in her role as a property management accountant. And it's been very challenging because the AI doesn't have any data as sample, as sample information to be able to know what's right. So it's just making up stuff because it's trying to answer the question. And more than half of the stuff that she's getting is just like, this is not right at all. It's just terrible.
Yeah.
Because it doesn't have data to pull from. So, so that being said, it is important to just, I guess, note that AI is an amazing tool, but that needs a high level of supervision if you really want to make sure that you're leveraging it right.
Yeah. I would agree with that, 100%. And now that you mentioned the 5-year-old, I wonder if that will be our new guideline. Like, oh, AI is now a 6-year-old. We've made it to 7.
Yeah. Maybe.
The teenage years are going to be rough, though.
Yeah, that's when they start rebelling. That's when it becomes a problem.
Yeah, for real.
So,
Let's hope we don't have that. We don't have to worry about like the teenage angst and AI. That would be awful.
yeah.
You're not my mom anyway.
Well, Dane,
Oh my God.
as we kind of wrap this thing up, I know we kind of talked about the changes, we talked about the generalities of SBA, all of that going into it. I guess to leave us off with one more question, what's one thing you would say every investor or even business owner should understand about going ahead and receiving SBA financing or even any other type of financing in 2026?
Yeah. So if you're in the credit box, which is now a U.S. citizen, there's incredible flexibility with it for expanding, especially expanding your business. Creating a new business is really where it can dominate. One thing to emphasize, I think, is that SBA is for active businesses, not passive business. So like if you're buying an apartment building, a mobile home park, those type of businesses are considered passive. But if you're buying a storage center, if you're buying an RV park, if you're expanding your mom and pop restaurant to 2 locations, those fit the SBA way, really good. Where a bank might look at your, let's say you have a little restaurant, like let's call it a Pizza Hut, and you're like, hey, let's buy a second Pizza Hut. Let's open a second one. A bank might be like, no way. But SBA would be like, oh yeah, looks great. Your pro forma, you have experience, you have a pro forma that matches the minimum requirements, you're approved, right? So in a way, to me, it's a little scary, I think, because it's like almost too easy. Like, there's a lot of paperwork, don't get me wrong, but like they're giving out money maybe to people that shouldn't quite get it. The bank is a little more careful with it.
Fair enough.
Yeah.
All right. Well, that's good to know. So if you're out there watching, if you're watching this podcast and you have an idea for a business, please let us know. I'm going to get you connected with Dane over here, and he's going to find some money out of an SBA pillowcase to just give you so that you can start your newfangled business idea.
Yeah. One thing to keep in mind is you need to have experience, or you need to have somebody in your organization with experience. Yeah. That's the number one problem I see. Like somebody who, let's say somebody's like, my dream's to open a nail salon, and their background is a teacher. And you're like, well, where's the experience of doing this?
I see.
But if they can parachute in a nail stylist who's been doing just styling the nails and some management experience in the salon, they put them in at like 10% ownership. Now they qualify, right?
So they have to be an owner.
Ideally, you can, if there's like an official management you set up, like
a director position of some type or anything like that.
So like a good example is a franchise. Like the SBA loves franchises because they train you and they already do some due diligence before they give you a franchise. Mm-hmm. And that due diligence is almost always stricter than the SBA guidelines. Mm-hmm. So let's say you want to like open a Marco's Pizza, right? A fast growing pizza chain. They're going to be like, what's your background, right? Should we even give you a franchise? And then they're going to train you. They're going to have the entire playbook. They're going to analyze the locations for you. That the SBA is like, man, this was so easy because they've already done all our work.
Yeah.
Right.
We're following a system that's already been proven by other operators of that.
Exactly.
Yeah, it's just rinse and repeat.
So in that situation, it's like there is in-house management in a way because you're being trained, you're using their system. So experience is not as important in that situation.
Gotcha. Well, the experience is coming from the franchise itself.
Exactly.
Yeah, leveraging that. Yeah.
I see. Okay. Well, that's good. That's been great information. And Dane, I appreciate you taking the time to come out and chat with us. Yeah, for sure. Where can people find you if they have any additional questions about any kind of loan? Because you really kind of dabble in a bunch of different loan types. So if anyone has any questions about mortgage lending in general, where can they find you?
Yeah. So, I mean, I guess they could Google my name, Dane Foxworthy, or
Okay.
if they want to reach out to you, that's fine as well.
Okay, great. Well, what we're going to do is we're going to go ahead and put your information in the comments
Oh,
below,
okay.
so that
Awesome.
people can reach out to you. Again, we appreciate you coming out and kind of sharing with us some of your knowledge about SBA loans. I think that's been very helpful. I learned something today, so that was really great. It's always cool to learn something new. So I appreciate you taking the time to chat with us.
Yeah, absolutely.
yeah.
Appreciate you guys having me on.
Yeah, that's great.
It was fun.
My
We'll have to do it
name's
again another time.
Yeah, for sure. My name's Gus,
And I'm Brad.
and this
I'm
is
Dane.
the Commercial Department Podcast. Yes, and this is Dane, exactly. And if you guys have any comments about what you heard today or have any questions, please make sure you comment below, and we will definitely get back to you ASAP. If you have any questions about commercial real estate or about starting a business, we're happy to help. We love to be a part of this. So thank you so much for your time, and we'll see you guys next time. Peace.